Welcome to the deep dive. Today, we're embarking on a journey into The Mindful Investor by Maria Gonzalez and Graham Byron. Think of this as your personal guide to understanding how bringing mindfulness to your finances can lead to, well, greater peace of mind and stronger financial footing.
Yeah, and what's really interesting is when this book came about, Gonzalez and Byron published The Mindful Investor right after the 2008 financial crisis.
Yeah,
It wasn't just, a market dip. It really made people question the whole approach to money.
definitely.
The authors saw that something was missing in the usual financial advice, our inner state, basically. They believed a different way of thinking is, well, essential for navigating the ups and downs of personal finance.
Absolutely. And that's what we're going to explore with you today. Consider this deep dive your chapter by chapter roadmap to the core ideas, the practical techniques, and those crucial actionable insights from the mindful investor. Our goal is really to give you a solid understanding of their approach so you can see how these principles might fit into your own financial life.
Okay, let's jump right into chapter one then, how we got here and how we'll get out. This chapter gives a really insightful look at what contributed to the 2008 mess. The authors point to a period of incredible economic growth that, well, unfortunately led to some pretty unrealistic expectations.
Right.
There was this widespread feeling that things would just keep getting better, and maybe the usual rules of risk didn't quite apply anymore.
Okay, let's unpack that a bit. Gonzalez and Byron talk about a shift in what people focused on, right? It seemed like the emphasis moved away from like a sense of responsibility to ourselves to the bigger picture and toward this feeling of entitlement.
Yeah,
People started to feel like they deserved constant increases in wealth almost automatically.
exactly. And this sense of entitlement, it really fueled a cycle of both greed and fear. As the economy grew, so did the worry of missing out on those gains, which kind of ironically made people even hungrier for more.
Hmm.
The authors make a key point here. Even before the crisis hit, a lot of people felt unfulfilled. This constant craving for more stuff, more recognition actually disconnected them from their core values and what truly makes us happy. They were chasing something that wasn't really there.
And it wasn't just individuals caught up in this, was it? The book also listed the role of businesses and investment advisors. What were some of the main mistakes they highlight there?
Well, what's fascinating is how interconnected everything was. The authors suggest that management teams increasingly focus on short-term profits and rising stock prices, often at the expense of long-term strategic thinking.
Right, the quarterly numbers.
Yeah, exactly. Flawed bonus structures, for example, where executives got huge rewards for short-term gains, unintentionally encouraged behaviors that just weren't sustainable. This created a gap between what looked good for shareholders right then and the long-term health of the company and the wider economy. It almost seemed like companies that didn't play this short-term game were seen as falling behind.
And investment advisors weren't immune either. I remember that time there was just this constant push for higher and higher returns.
Oh, absolutely. As markets climbed and seemed to bounce back quickly from any dip, the mindset really shifted. Clients who might have been more cautious before started pushing their advisors to take on more risk, FOMO, fear of missing out.
Yeah.
There were even stories of brokers facing lawsuits for not generating high enough returns. So this put advisors in a tough spot, fearing losing clients if they seemed too conservative.
Pressure from all sides.
Definitely. Many felt pressured to maybe bend their own principles and chase those higher returns, even if it made them uncomfortable. And even advisors trying to stay the course were often relying on analyst reports that painted a very rosy picture, often fueled by companies wanting to keep shareholders happy.
So the authors really paint a picture of a widespread misstep, a kind of like shared delusion.
That's a really central insight. They argue that while it's easy to look back and point fingers, the reality is that pretty much all parties involved, individuals, organizations, were to some extent misguided. There was this forgetting of the basic idea of serving others and a widespread embrace of this entitlement thing.
Not everyone, surely.
Well, of course, not everyone fell into this trap, but enough did to cause those huge global consequences.
And this leads them to the House of Cards analogy, doesn't it? Can you explain what they mean by that?
Yeah, the House of Cards is such a powerful image. The authors connect the eventual collapse to several linked factors. First, there was this strong attachment to endless gain, this constant need for more. Then, underneath it all, was the fear of having less than others.
Keeping up with the Joneses.
Exactly. Third, there was a delusion that this crazy growth period could just go on forever. And finally, there was this really dangerous connection people made between their self-worth and how much stuff they owned. These tendencies, which they later call hindrances, create this really fragile system that was almost bound to fall. When the market stumbled, it wasn't just about losing money. For many, it felt like a personal failure.
It's a sobering thought how much our sense of who we are can get tangled up with our bank balance.
Yeah.
So according to Gonzalez and Byron, what's the way out of this cycle? This is where mindfulness comes in, right?
Exactly. They introduced the practice of mindfulness as a really transformative approach. They emphasized that there's actual scientific evidence showing it's effective in managing stress. And what's really interesting is their point that regular mindfulness meditation can actually change our brain wiring, leading to greater happiness.
And it's not some niche thing.
Not at all. They give examples of top performers like Tiger Woods and Phil Jackson using meditation to sharpen focus and stay calm under pressure. They even mention companies like Google offering it to employees.
And there's that really compelling story about Maria Gonzalez leading a spontaneous meditation with 500 business leaders. That really sticks with you.
It does. At the end of this intense conference, totally unannounced, she guided these super busy executives through a simple 15-minute meditation. The room, 500 people, just went completely silent and still.
Wow.
Afterwards, the feedback was overwhelmingly positive. People felt this profound calm and were really interested in bringing mindfulness into their own companies.
So what's the core message of this first chapter? What's the main thing you, our listener, should take away?
The central idea is that mindfulness isn't some magic quality you either have or don't. It's a skill you can actually learn. By cultivating it, you can develop clearer thinking, make more thoughtful financial decisions, and stay focused on what truly matters. It offers a way to replace those destructive emotions, greed, fear, with calm and focus when dealing with money. Like Pasteur said, Kant favors the prepared mind, and mindfulness is a way to prepare your mind.
Okay, that sets the stage perfectly for chapter 2, an introduction to mindfulness meditation. Now that we understand why it's important, the authors explain what it actually is.
That's right. They define mindfulness meditation pretty simply. It's the intentional practice of paying attention to and being aware of the present moment, using specific techniques. It's about consciously choosing to be fully present without getting swept away by distractions.
It almost sounds paradoxical, like intentionally becoming natural. Can you explain that a bit more?
Well, think about learning, say, a musical instrument. At first, you have to really concentrate on every single note, every finger movement. It feels very deliberate.
Yeah, clumsy even.
Right. But with practice, it becomes more fluid, more automatic, more natural. Mindfulness meditation is kind of like that. You're intentionally training your mind to come back to the present when it wanders. And with consistent practice, this ability to just be present becomes less effortful, more of a natural state.
And the authors really emphasize that this training gives you greater control over your mind, which seems so crucial when we think about how emotional money decisions can be.
Absolutely. An untrained mind, they argue, is easily swayed by external stuff, the market going up or down, bills arriving, even just a casual comment someone makes about money. These things can trigger really strong emotional reactions. But a mind trained through mindfulness learns to observe these triggers without immediately reacting, to see them for what they are, just thoughts, just feelings. Without this training, our minds can become like a runaway train, really disrupting our inner peace.
So how does this mental training actually work? What are the benefits that come from this regular practice?
The authors highlight several key benefits. First, it deepens your ability to concentrate, to really focus. Second, it brings greater clarity about yourself, your motivations, what pushes your buttons, and about the world around you. And maybe most importantly for investing, it cultivates equanimity.
Equanimity, that ability to accept what is happening without resisting it, that sounds particularly relevant to dealing with the, inevitable ups and downs of the financial markets.
Exactly. With practice, you start to develop this ability to accept market volatility, the changes in your portfolio's value. It doesn't mean you become passive or just give up.
Right, you still act.
You still take action where you can, like adjusting investments to match your goals and risk comfort. But you learn to accept the things you can't control, interest rates, global events, without getting totally thrown off balance emotionally.
The book also mentions 3 key qualities developed through mindfulness: concentration, clarity, and equanimity. Can you explain how each of those specifically helps with making financial decisions?
Sure, concentration lets you truly listen when your financial advisor is explaining something complex without your mind drifting off. Clarity gives you a deeper understanding of your own financial priorities and life goals, making you less likely to be swayed by short-term fads or emotional urges.
Like panic selling.
Exactly. If you're clear that your main goal is long-term security, you're less likely to sell in a temporary downturn. And equanimity, as we said, helps you accept market swings and make decisions based on facts in your plan, not fear or greed.
It sounds like mindfulness meditation is about developing a more objective, less emotionally reactive way of looking at our financial lives.
Precisely. The authors explain that it involves paying extraordinary attention to ordinary experiences. This focused attention, combined with equanimity, leads to both insight and purification.
Insight and purification. Can you tell us more about those concepts? They sound a bit deep.
They are, but it makes sense. Insight here means a deep understanding of basic human stuff, like how our desire for pleasure can cause suffering if we get too attached, how pain gets worse when we fight it, and just the nature of ourself. Purification happens when you observe what's going on, especially inside yourself, without trying to fix it or change it.
Just watching it.
Yeah, this process gradually dissolves the mental and emotional blocks to happiness that often come from our constant need to control everything.
That really connects with the idea of freeing up mental energy by letting go of that need to control.
Absolutely. The authors point out that constantly trying to control every aspect of life, including the financial markets, just drains you. When you start letting go of that, you feel this sense of liberation, this freedom from needing things outside yourself to be perfect for you to be happy. Your actions actually become more effective because they come from awareness, not attachment.
Making decisions based on what's really important.
Exactly, rather than just emotional reactions.
And the benefits of mindfulness go beyond just our personal relationship with money, don't they? The book touches on broader advantages too.
Oh yeah, they highlight the research-backed benefits. Reduce stress, better focus, handling multiple tasks better, improve time management, better client service, even enhance creativity. For teams, practicing mindfulness together can improve effectiveness, make meetings more productive, boost performance, and help resolve conflicts more easily.
So it's really a holistic approach, positive effects across different areas of life, personal and professional. What are the key conditions for success with mindfulness meditation, according to Gonzalez and Byron?
They really stress two crucial things. First is motivation, a genuine desire and willingness to actually do this mental training to help yourself. The second is consistent practice, ideally daily.
Even just for a short time.
Yeah, even short sessions like 10 or 15 minutes can be beneficial. But regularity and building momentum are key. They wisely suggest it's better to practice a little bit every day than for longer periods only now and then.
That makes perfect sense, building a sustainable habit. Okay, so after laying the foundation of why and what, Chapter 3 dives into the how with mindfulness techniques.
Exactly. This chapter gets really practical. It focuses on generic mindfulness techniques you can apply not just to finance, but to, well, pretty much anything in life. They introduce both formal meditation practices and what they call mindfulness and action strategies.
And they immediately reassure readers, which I think is important, that even if you feel like you can't quiet your mind, you can learn and benefit with motivation and regular practice, even just 10 minutes a day.
It is really encouraging. They then highlight what they see as the 5 most important things when dealing with money and maybe life in general. These are the ability to calm yourself down, self-awareness, living in the present moment, imagining positive outcomes, and being comfortable with not knowing.
Okay, let's explore some of these. They start with internal awareness, which is about observing the feel, image, and talk spaces within ourselves without judgment. What does that actually involve?
Right, so the feel space is the physical sensations in your body, that tightness in your chest when you're anxious, the lightness when you're happy, shoulder tension when stressed. The image space is where your mental pictures live, memories, daydreams, worries you visualize. And the talk space is that internal chatter, the constant stream of thoughts.
The inner monologue.
Exactly. The key with this technique is to simply notice what arises in these spaces without getting sucked into the story or judging it as good or bad. It's about being a neutral observer of your own inner world.
And they really emphasize how these physical sensations, the feeling body, can strongly influence our behavior, sometimes clouding our judgment, especially with money decisions.
Oh, absolutely. They give a great example. An investor sees their portfolio drop. The physical feelings of fear, knot in the stomach, racing heart, combined with mental images of losing everything and that panicky inner voice, it gets overwhelming, and they impulsively sell everything, often at the worst possible time.
Yeah, reacting purely from fear.
Right. So the authors encourage you to pay attention to what's happening in your body when you hear financial news, good or bad. It builds self-awareness and helps prevent these emotional hijacks.
Okay, next they discuss external awareness. How is that different and why is it important?
External awareness is about being fully present with what's happening outside yourself, the sights, sounds, smells, tastes, textures of the current moment. The authors stress that life happens now, in the present. The past is gone, the future isn't here yet.
Makes sense.
By cultivating external awareness, you can better appreciate life's experiences, make clearer decisions, have better judgment, suffer less from worrying about past or future, and just feel more fulfilled. It lets you really hear what someone is saying instead of just filtering it through your own thoughts.
And this connects with their discussion of single-pointed focus and the dangers of multitasking, especially when we're dealing with important things like talking to a financial advisor.
Exactly. They point to research showing how much our attention drops when we try to do multiple things at once, like checking our phone during a meeting. The core idea is our focus is limited. Even when we think we're multitasking, we're really just rapidly switching attention, which means we're not fully engaged in any task.
So being fully present with your advisor is key.
Absolutely critical. Truly listening, asking questions.
They also briefly mentioned sight space and sound space as present moment experiences within this external awareness.
Yeah, basically sight space is just what you see right now. Sound space is what you hear right now. Traffic, birds, someone talking. The key takeaway is both exist only in the present.
Okay. Another interesting technique is creating imagining positive outcomes. This almost seems like the opposite of just observing the present.
It might seem that way, but it's more like intentional mental rehearsal, actively cultivating positive mental images. The authors compare it to visualization used by athletes like Tiger Woods, mentally practicing successful swings.
Right, picturing success.
Exactly. This can be really valuable in financial planning, helping you envision your desired financial future, which they explore more in Chapter 6. It's about creating a compelling mental picture of what you're aiming for.
Finally, they discuss being comfortable with not knowing. That feels particularly relevant in the often uncertain world of finance.
It really is. The authors encourage you to resist that urge to jump to conclusions or feel you need all the answers right now. Instead, they suggest accepting that feeling of uncertainty, being okay with it.
Leaning into the confusion.
Kind of, yeah. By allowing that space of not knowing, insights and answers often arise more naturally, and your judgment improves. It's about trusting the process of discovery rather than forcing a quick, possibly wrong decision.
And the overarching message here is that these techniques, formal meditation, mindfulness, and action, should become a regular part of your routine, ideally daily.
Absolutely. They recommend exploring guided meditations and consciously applying these strategies throughout your day. The goal is gaining greater control over your mind so it serves you effectively, leading to healthier relationships, including your relationship with money.
All right, this brings us to Chapter 4, the 5 hindrances that impede success. This chapter explores the common mental obstacles that can, well, sabotage our well-being and our financial decisions.
That's right. The authors identify 5 key hindrances: attachment, aversion, delusion, envy and jealousy, and pride. They emphasize that while everyone experiences these sometimes, just becoming aware of them is crucial for stopping them from messing up our lives.
Let's break these down and see how they show up in financial behavior. They start with attachment. What do they mean by that?
Attachment in this context is that strong clinging to things we like or desire and the fear of losing them. Financially, this could be an unrelenting drive to get more wealth and an inability to let go of investments, even when it's clearly time.
Like holding on to a losing stock, hoping it comes back.
Exactly. Or the example they give of people buying houses they can barely afford and then being unwilling to downsize even when things change because the house becomes part of their identity.
Okay. Next is aversion, which is wanting things to be different from how they actually are.
Right. In finance, this might look like resisting market downturns or stubbornly holding on to unrealistic return expectations. It's refusing to accept the reality of the situation, which leads to bad decisions like holding on to that losing investment indefinitely.
Then there's delusion, misunderstanding reality.
The authors give examples like believing a period of high market returns will just go on forever, or thinking that accumulating more stuff will automatically lead to lasting happiness and self-worth. These delusions can lead to taking way too much risk or prioritizing wealth over deeper values.
The fourth hindrance is envy and jealousy, wanting what others have, the keeping up with the Joneses thing again.
Pretty much. This often means spending beyond your means to get what others have, the fancier car, bigger house, luxury stuff. The authors point out this creates a feeling of inadequacy, believing satisfaction lies in having what someone else has. But that satisfaction is usually short-lived because there's always someone with more, leading to this endless cycle of wanting.
And finally, pride, which they say shows up in two ways: superior and inferior pride.
Yeah, superior pride is that I know better than everyone else attitude. It can lead to overconfidence in investment decisions, dismissing expert advice. Inferior pride is the opposite, feeling inadequate or unworthy. This might mean blindly following trends out of fear of missing out, or believing you're just not capable of managing your own money. Both types of pride can lead to irrational and potentially harmful financial choices.
It's really eye-opening how these deep psychological patterns play out with money. The author stressed that everyone experiences these sometimes.
That's a crucial point. It's just part of being human. The goal isn't to completely eliminate these feelings, probably impossible, but to become aware of them. Without awareness, we lose our choice and just react impulsively, driven by these underlying urges.
And they make a really important distinction between being driven by these hindrances and being truly motivated. Can you explain that difference?
Being driven by hindrances often feels like an insatiable craving, like you're out of control. It's like being on a treadmill, constantly striving but never satisfied. Motivation, though, is more focused and engaged towards your goals without that underlying desperation or compulsion.
Like Woods or Jackson again?
Exactly. The author suggests their mindfulness practices help them stay motivated and effective without being slaves to this relentless drive for more.
Okay, so becoming aware of these five hindrances is the first key step towards making more conscious, less reactive financial decisions. This naturally leads us into chapter 5, the starting point.
Exactly. This chapter really ties together the mindfulness principles we've discussed with the nuts and bolts of sound financial planning. The authors emphasize how that increased awareness, focus on your true goals, developing equanimity, and greater acceptance, all cultivated through mindfulness, can seriously enhance your approach to financial planning.
And they encourage you to take some time to really reflect on which of those five hindrances we just talked about might be particularly active in your own life right now.
Yes, but again, they stress it's not about judging yourself or trying to wipe these tendencies out overnight. It's about cultivating that initial spark of awareness. That awareness is what empowers you to start making more mindful, deliberate choices instead of just running on autopilot, driven by unconscious patterns.
The chapter then introduces some really relatable, common client profiles they've seen. These really help illustrate how these hindrances play out in real life, don't they?
They absolutely do. They describe the conspicuous consumers. They look successful, but are often deep in debt, constantly try to keep up appearances, driven by maybe all five hindrances, never really satisfied. Then there are the postponers. They delay all enjoyment, focusing only on some distant retirement, maybe missing out on life now, also often influenced by various hindrances.
And the third one?
The pleasers. They live their financial lives based on what others expect, often feeling uneasy despite their achievements. They're attached to others' views, averse to displeasing people, maybe deluded about their own desires, often envious, and can experience both superior and inferior pride.
Understanding these profiles can really help you recognize patterns in your own behavior and, more importantly, start to uncover what your true financial goals actually are, not just what you think they should be.
That's the core insight. The authors emphasize developing internal security and reducing that underlying suffering we talked about in Chapter 3. This lessens the need for constant external validation, which often drives those unhealthy patterns. They really encourage you to take an honest look at your choices and ask, do I want to keep living this way, driven by these unconscious habits?
And the culmination of this deeper self-reflection is developing a personal mission statement and a clear vision for the life you truly want.
Precisely. Once you have that clarity about your values and aspirations, setting meaningful financial goals becomes much easier. You're better equipped to answer those fundamental financial planning questions based on what truly matters to you. This lets you create a plan that genuinely supports your vision of a fulfilling life now and in the future, which sets us up perfectly for Chapter 6, the financial plan.
Now we move from the more introspective work to the really practical nuts and bolts aspects. The authors describe the financial plan as a computer-generated forecast.
That's right. It's essentially a tool that helps you project whether you have the resources to achieve the life goals you've identified, or if adjustments are needed either financially or maybe even rethinking some goals.
And they really emphasize that the plan isn't just a one-time thing you do and forget. It's a living document, a crucial reference point for everything else financial.
Exactly. It should be the central hub you and your advisor revisit and update as life changes and markets evolve. Before diving into specifics, the authors strongly advise you to actually write down that personal mission statement from Chapter 5, along with your top 3 hopes or goals and your 3 biggest financial fears. These are critical inputs for building a truly personalized plan.
What kind of information typically goes into creating a really comprehensive financial plan? It sounds like a lot.
It can be, but it's important. The authors outline a fairly standard list: basic personal data, detailed current and projected expenses, now and in retirement, current long-term savings, anticipated retirement dates, any education funding needs, info about wills, current and forecasted income, any pension details, personal assets like your home, and of course a full overview of your investment assets, original cost, current value, and reasonable assumptions for future returns and their historical volatility, often called standard deviation.
Okay, volatility, how much the price might swing.
Exactly. It gives you an idea of the potential range of ups and downs.
They then delve into several key areas, starting with retirement dates. What's their perspective on that?
In today's world, they suggest thinking of your retirement date less as fixed and more as a flexible target. They recommend running different scenarios in your plan, retiring maybe 5 years earlier or later than planned, to really understand the impact on savings needs and potential retirement spending. It gives you a valuable buffer.
They also discuss the big shift from defined benefit pensions to defined contribution plans like 401ks.
Yes, and they explain the difference clearly. Defined benefit plans promise a specific income, while defined contribution plans put the saving and investing responsibility on you. If you still have a defined benefit plan, they advise carefully checking your pension booklet or using software to get a realistic income estimate.
Expenses are another huge piece. They use a striking example of a high-income family actually spending more than they earn.
That example really hits home the importance of tracking expenses. Even with a $200,000 income, the family was spending $2,000 more than they brought in each year. It shows how easily we can lose sight of where money goes and how seemingly small, regular indulgences, especially on credit, can have massive long-term consequences.
And they connect this back to the hindrances again.
Right, highlighting how attachment to a lifestyle or envy can fuel debt.
And they have some thoughtful advice in a section called Money and Kids, emphasizing the parent's role in teaching good financial habits early.
They strongly advocate resisting the urge to always give kids what they want immediately. Instead, teach them the valuable skill of waiting and saving. They also suggest involving the family in decisions for some budget areas, like vacations, to foster shared understanding and responsibility, habits that can last a lifetime.
It's a good reminder that even small, consistent spending adjustments can have a surprisingly large impact long term. The financial plan really helps visualize that power.
Exactly. The results section, especially net worth projections and visual charts, gives a clear picture of your trajectory. The authors do caution against getting lost in spreadsheet details and missing the big picture the visuals show.
They also introduce a really important concept, sequence of returns risk, using the example of two brothers, Tom and Jim, with identical average returns but in a different order.
That's a classic illustration. The timing of returns dramatically affects the outcome. Tom, with early positive returns, did much better than Jim, who faced early losses. It highlights the risk of big losses close to retirement when you have less time to recover.
And to get a more realistic sense of potential outcomes, they introduce Monte Carlo simulations. Sounds complex.
It's a powerful tool. Monte Carlo takes the average expected return and runs thousands of scenarios by randomly shuffling the order of those returns based on historical volatility, standard deviation. This gives a much better sense of the range of possible outcomes, not just one straight line. They even provide sample return and volatility figures for stocks, bonds, and cash.
The authors are really clear that your active involvement in the planning process, partnering with an advisor, is absolutely crucial.
Absolutely. Don't just passively receive a plan. Engage, ask questions, understand the assumptions. They even suggest a simple but insightful experiment. Imagine putting your entire portfolio in cash. This helps assess your fundamental spending needs and whether investment risk is even truly necessary for you.
And as you consider different portfolio options, they strongly urge keeping your mission statement and those 5 hindrances in mind.
Yes. Tune into your feel, image, and talk spaces as you consider strategies. Practice equanimity with the emotions that arise: excitement, fear. Aim to decide from clarity and values, not fear or greed. Experiment with different asset allocations in the plan to find a mix and spending level you feel genuinely comfortable with. And use the creating positive outcomes technique from Chapter 3 to vividly envision your desired future and let that guide your planning.
Okay, this naturally leads us to Chapter 7, portfolio construction. Once you have the plan and an initial asset allocation idea, the next step is picking the specific investments.
Exactly. This chapter explores how building a well-diversified portfolio, different types of investments that don't all move together, can effectively reduce risk while still aiming for your target returns long-term.
They again stress being present and listening mindfully during talks with your advisor about investment options, foreshadowing Chapter 8 on mindful listening.
It's absolutely crucial that you understand your strategy and investments right from the start. The authors share a story from the '87 crash, where clients seemed totally unaware of what they owned, even after workshops. It really underscores the need for clear, ongoing communication and genuine understanding.
They emphasize the client-advisor relationship should be a true partnership, a team effort. You shouldn't just blindly rely on the advisor.
Precisely. They warn against two pitfalls: constantly chasing the next big thing or just giving up and letting the advisor handle everything.
Hmm.
Both undermine clarity and equanimity. Approaching your portfolio calmly and clearly helps you react thoughtfully to news without immediate panic.
A key piece of advice: only include investments in your portfolio that you truly and completely understand.
Yes, you need a solid grasp of what they are, how they generally behave, and where to find reliable info. They use the simple example of a 50-50 stock bond portfolio to show how understanding your basic allocation lets you quickly estimate market news impact, reducing anxiety.
They also wisely warn against blindly following experts, reminding us of past bubbles fueled by expert pronouncements.
Maintaining beginner's mind, questioning trends is crucial, like checking food labels. Understand what you're buying when investing.
The authors highlight three key criteria for choosing investments: a long enough history for return estimates, a track record of volatility, standard deviation, and ideally, simplicity.
They then define the basic building blocks: cash, bonds, stocks. Explain bond ratings, assess the issuer's ability to pay interest and principal, and discuss why even large institutions include stocks, balancing safety with the need for growth to beat inflation long-term.
They also briefly touch on different ways to invest individual securities, mutual funds, ETFs, managed portfolios, and note potential advisor bias.
They encourage you to step back and consider the pros and cons of each approach, not just accept the advisor's default. They also caution against hindsight bias, blaming advisors for past losses or missed opportunities. Predicting markets consistently is incredibly hard.
The importance of sticking to your original portfolio mix, assuming it still fits your needs, and managers stick to their style, is really emphasized.
While rebalancing periodically is necessary, it should be thoughtful, not a knee-jerk reaction. They introduce the core and explore method, a way to dabble in new areas while keeping a stable core, but warn about losing track of the explore part.
They describe traditional balanced portfolios like 60-40 stock bond and variations for different risk tolerances, and address the misconception that retirees shouldn't hold equities.
Right. With longer lives, even retirees often need equity growth to fight inflation over potentially decades. Ultimately, determining the mix is collaborative between you and your advisor, considering your unique situation, risk tolerance, goals, ideally using planning software.
After settling on a mix, they advise going back to the plan, updating it with component percentages and standard deviations, and rerunning a Monte Carlo simulation.
This step lets you really assess your comfort with the potential outcomes. The goal isn't winning at investing, but finding a portfolio you're comfortable with that has a reasonable chance of meeting your goals while maintaining clarity, equanimity, and peace of mind.
They also briefly introduce active investing, using value investing, and Benjamin Graham's Mr. Market allegory.
This highlights the mindful value investor's focus on company fundamentals over market whims. Finally, they stress ongoing due diligence by you, your advisor, their firm, to ensure investments remain suitable and managers don't drift from their style.
Okay, now we move on to Chapter 8. Client-advisor relations, a really crucial aspect of navigating the often complex world of finance.
Absolutely. The authors cleverly frame this as a mini-strategic alliance, drawing on Maria Gonzalez's corporate experience. Finding the right advisor can significantly strengthen your financial life.
And just like any business alliance, they stress strategic alignment and genuine compatibility are key for working harmoniously towards shared goals.
Exactly. They outline a 5-step process applying corporate alliance principles. 1. Develop your strategy, know your goals and what you seek in an advisor. 2. Select an advisor who understands and values your strategy and with whom you're compatible. Fees are secondary to this fit. 3. Structure the alliance, agree on an action plan, responsibilities, fees. 4. Maintain the alliance ongoing effort, communication, following the plan. 5. Evaluate the alliance periodic reviews beyond just performance, considering trust and communication.
They break the relationship into three main stages: introductory meetings, formal agreement, and ongoing maintenance evaluation. Let's start with those introductory meetings. What should you, as a potential client, look for?
The authors say these initial meetings are prime time to assess the advisor's philosophy. Pay attention. Do they truly listen? Do they have your best interests at heart? Do they empower you or control information? Can you learn from them? Do they aim for a win-win?
Look for someone gentle, relaxed, genuinely helpful.
Yes. Rather than just the smartest or most arrogant, key qualities to assess. Genuine desire to help you reach your goals, intelligence to explain complex things simply, honesty, real depth of knowledge, ask about recent learning, and a big mind, broad perspective, tolerant of other methods.
Okay, once you decide to move forward, there's the formal agreement stage. What's important here?
While an investment policy statement, IPS, is standard, they suggest going beyond boilerplate. Incorporate mindfulness principles for a more customized, understandable agreement. And crucially, ask all your questions, no matter how basic they seem. It's the advisor's job to ensure you understand completely.
And finally, ongoing maintenance and evaluation. What does that involve?
Consistent communication, regular reviews of performance against your plan and goals, and also stepping back to evaluate the relationship itself. The authors are clear, the advisor guides, but you are responsible for the decisions. You need to periodically assess if the portfolio and the alliance are still serving you.
Exert control from equanimity, make conscious changes, or affirm satisfaction.
Exactly. Treating the relationship like a strategic alliance maximizes success. Creates a mindful partnership, helps deal productively with financial emotions, leading to more objective evaluations and better decisions. Now, Chapter 9 tackles a tough topic. When things go wrong.
Yeah, unfortunately, a reality for many. Life throws curveballs.
Yes, despite planning, things happen. Illness, death, divorce, job loss, debt, business failure, market corrections, even fraud. The authors acknowledge resources, planner, accountant, lawyer, but stress the initial need is dealing with the emotional pain and facing the problem head-on.
Don't just hope it goes away.
Right. They remind you everyone faces disruptions, and feeling alone leads to despair. Cultivating compassion for others in similar spots can foster self-compassion. Their initial advice when facing a serious challenge: often do nothing immediately, unless it's life-threatening, to regain composure. Widen the gap between stimulus and response for better decisions. Use the internal awareness technique from Chapter 3 to untangle overwhelming feelings.
They then briefly touch on specific crises. For death, focus on financial safety for the survivor's healing period. Avoid major decisions quickly.
For divorce, highlight the often underestimated financial consequences. Job loss. Run scenarios with an advisor to inform decisions about recall, new jobs, or early retirement. Debt. Emphasize how fast small credit card debt grows and its long-term costs. Business failure. Recommend not initially treating the business as a personal asset in the plan, unless a sale is imminent, to avoid devastation. See it as an income source first.
And for a stock market correction, their advice really aligns with mindful investing.
Absolutely. Use relaxation techniques from Chapter 3, breath, body scan, awareness, to regain calm before deciding. Reiterate the value of the advisor relationship. Mention the mindful decision process in Appendix A. They remind us standard deviation covers most situations, 95%, but outliers happen. Equanimity will be tested. Practical advice. Have the planner update the plan with current low values to inform adjustments based on facts, not fear.
The section on fraud is particularly sobering, sharing a personal story.
They call fraud the cruelest way to lose money due to the intentional deception. Maria Gonzalez's story of being conned as a student shows how easily trust is exploited. They explain Ponzi schemes, using new money to pay old investors. Warn against telemarketing fraud. Unsolicited offers don't talk finance with strangers that way. Manipulators exploit our natural trust and desire to help.
The chapter concludes with a really profound message about reflecting on impermanence.
They emphasize reflecting on life's changing nature isn't morbid, but facing reality. This acceptance can be liberating. Developing mindfulness and equanimity helps not just survive tough times, but also grow and find deep joy independent of external conditions.
This brings us to Chapter 10. Estate planning, often put off but so essential for responsibility and peace of mind.
Indeed. They frame it as planning with the end in mind, noting many have more fire insurance than life insurance. They stress estimating the financial impact of your death on loved ones by adjusting your plan. Set date of death to tomorrow. This highlights how life insurance can mitigate the impact.
For those without a formal plan, they offer a rule of thumb calculation for estimating insurance needs.
Yes, considering income replacement needs, education costs, final taxes debts, charitable wishes, funeral costs, minus existing assets insurance. They recommend getting quotes from 3 agents for term, whole life, universal life, reviewing these with a CFP, or adding premiums to your plan to check affordability. They briefly explain the types.
And if the first quotes aren't right, try another 3 agents. No obligation just because they spent time with you.
Right. They also introduce critical illness insurance, living benefits, a lump sum if you contract a covered illness, providing crucial support.
Your will is highlighted as one of the most significant documents.
Absolutely. Expressing your wishes for your estate. Strongly recommend an experienced estate attorney. Bring a complete asset list, desired outcomes outline, insurance copies, potential executor list to the meeting. Being an executor is time-consuming, so keeping your paperwork updated is key. Deposit old share certificates, consolidate accounts, document asset cost improvements, consult an accountant on tax info.
They advise an even-handed approach when choosing beneficiaries, especially children, to avoid future resentment, emphasizing the unpredictable future.
And gently discourage trying to control things too much from beyond the grave.
They list circumstances warranting a will update: remarriage, divorce, death of spouse, executor, beneficiary, kids growing up, disposal of bequeathed assets, significant changes in tax net worth, gifting assets before death.
They also explain living wills, advanced healthcare directives, outlining end-of-life medical wishes if you can't speak for yourself, stress specificity, and consulting legal pros due to varying laws.
Trusts are discussed for managing affairs of disabled children or dependents, noting trustee responsibility and the option of hiring a trust company.
They touch on testamentary trusts in the will for heirs under a certain age and spousal trusts, benefiting a new spouse while preserving assets for prior kids. Caution about spousal trust complexity, get expert legal advice.
The chapter concludes meaningfully on charitable giving, adding purpose, and creating a legacy aligned with your mission statement.
Beautifully explaining the paradox. When you give, you truly receive deep connection, fulfillment. Mindfully considering how you want to be remembered and providing for family brings peace of mind.
Finally, Chapter 11, Final Thoughts, bringing it all together.
It starts with that Robert Burns quote about being trapped by past future thoughts, contrasting with the mouse living in the present. They then introduce the mindful decision-making algorithm from Appendix A as a practical tool.
Walking through the Clarice Kent-Carr example, define, explore options, paying attention to talk, image, feel, allow clarity to arise, don't force it.
Emphasizing it's often iterative you might cycle through. It's about approaching decisions with awareness, not impulsively. They briefly mention Appendix B on budgeting, critical for awareness decisions, and Appendix C on choosing a mindfulness teacher.
So bringing it all together, what's the core overarching message of The Mindful Investor?
The central message is clear and powerful. Cultivating a calm, focused, aware mind isn't just good for inner peace. It's essential for building and maintaining lasting financial security and well-being.
And for you, our listener, we really encourage you to reflect on the key insights and techniques from this deep dive. Consider how even small steps towards incorporating mindfulness into your financial life might lead to significant positive changes. Explore the book further. Check out online resources if you're interested.
Which brings up one final important thought for you to mull over. How might cultivating greater awareness, equanimity, and present moment focus not only improve your financial well-being, but also enrich and deepen all aspects of your life experience, leading to a more fulfilling journey overall?